So keep that in mind as we go through this example. So this is all made up. The name 1900 Waverly Street does not exist. That picture is not of a real property in Missoula, but all the other details of this deal are from an actual property that is available for sale here off market. As I mentioned, we get a ton of interest in apartments. People view them as safe. And so you have investors from both locally and then from all over the place that call when we list properties here. And we recently took a 38-unit apartment building to market. And inside of a week of it hitting the market, we had 7 offers, and then 5 additional offers came in after the building was already under contract. So that should give you some sense of how hot the market is. And again, it's not just from Missoulians. These are from people from all over the place that are interested in these assets. So like I said, it boggles their mind that things can trade at such low cap rates, but I will give you my best effort here to unravel some of the mystery of how these things work. So this is a 44-unit property. It's 3 stories. It was built in 2004. It has some deferred maintenance, needs some paint. The roof is probably got a few years left on it, and the rents are about 10% below market. The property is self-managed, which means there's some inefficiencies there where it could, a professional property manager could probably come in and squeeze some additional revenue out of it. The seller states that the NOI, the net operating income on the property, is $250,000. So that's what he's telling us, and that's what he's putting into his offering here. Price is $4.5 million, which works out to about $102,000 per unit. And for comparison's sake, a nearby 54-unit project sold in July for about $84,000 a unit at a 5.6 cap rate. So that gives you the background of the story. So can this deal be done is, I guess, this is the question. So to walk through this, the seller's saying they have $250,000 NOI. The sale price is $4.5 million. That means you have a 5.55 cap rate, which, given what things have sell for here in Missoula and then regionally and nationally, that's about where they go, which sounds low, but that's what they are. Couple problems, though, is that the seller's NOI is pro forma, and it's a projection based on 100% occupancy, so full occupancy and the current expenses. So there's 2 big problems with that. One is you have to count vacancy, and not because I say so, but because the bank and appraiser will say so. If you apply a 5% vacancy to this particular situation, your net income is actually $18,000 less than what the seller is saying. Second is the seller is calculating the NOI based on current tax burden and its current assessment. And if any of you have property in Missoula, you have seen that current assessments don't stay current for very long, and when this property sells, the assessment will go up and causing the taxes to go from about $33,000 a year to about $60,000 per year. So that becomes a $27,000 hit to your net income each year, just off the top. So missing this bid is a pretty common mistake that we see with property owners, that they do all their underwriting based on the current assessment, but it will very, very often go up after sale. So something important to pay attention to. So you take the vacancy understatement and then the tax issue, and there's a total of $45,000 in expenses that aren't accounted for in what the seller is stating. So yeah, sellers will often, discount what a scummy real estate broker has to say about any of this stuff. But again, it's not me that matters or any broker. It's what the bank and the appraiser says when you go to finance this thing. So with all that considered, what does that do to the acquisition cap rate? It means that you have $205,000 NOI. If the sale price stays the same, that means your real cap rate is 1 full point lower. It's 4.55. So can that be banked is the big question. So we're assuming a Freddie Mac small balance loan, which is very common, so agency debt to do this deal. And this slide is taken straight from the Freddie Mac website, and they consider Missoula to be a very small market. So if you look at a very small market, they say we need a debt coverage ratio of 1.4, and the maximum loan to value on a refinance is 70%, and then the maximum acquisition loan to value is 75%. So you take those 2 data points. The reason that people are after agency debt in most cases is because they will offer 30 years of amortization and non-recourse lending. So very attractive to a lot of people. So And then, for the sake of the argument here, we're saying that the interest rate that we can obtain is at 3.75% on 30-year money. So how does that work out if you pay $4.5 million for this property? Can you actually get the deal done? So remember, the annual NOI is $205,000, not $250,000 after we corrected it. Your annual debt service on that loan is going to be about $187,500, which means you have $17,500 to play with. It's kind of slop margin if things go wrong, or cash that you can actually put in your bank account. So on a $4.5 million property, $17,500 of cash flow is not a lot. And then keep in mind, this has deferred maintenance, so you're going to have to replace a roof at some point. Boilers tend to blow up around 20 years. There's a lot of things that can go wrong. You need some paint. So is that enough cash flow to cover those eventualities when they do happen? The way the bank will assess this is through a debt coverage ratio. And the way the debt coverage ratio is determined is you just take the NOI of the property, you divide it by the debt service, the principal and interest, and that will give you your debt coverage ratio. And it's basically the bank's way of determining how much margin is there if things don't go quite as planned. So this deal, as stated, is 1.09, which is not bankable with any bank that we have really dealt with. So in its current state, the max purchase price with that kind of loan that could be supported based on the bank's requirements would be $3.5 million, which is a full $1 million off of what the seller wants. So that's not within negotiating range in most cases. So what are your options if you actually want this deal? What can you do to close the gap? So you can put more money down, which is not exciting because the more money you put into it, the lower your yield is. Or you can try to negotiate the seller down, which sounds great, but I think he's convinced there is a gold mine buried beneath that property and is not willing to let go of it, without a fight. So now what do you do, and can this be salvaged? So if you go out to your some friends, family, and fools, and you convince them to boost your down payment, they'll come invest with you, boost your down payment from 25% to 35%. And in the back of your mind, you're remembering that there's the rents are below market, so that you could relatively easily make some management changes, get rents back up, and now your overall investment performance starts to look a little bit better. On top of that, rents have been growing by about 2.5% to 3% per year because Missoula's population is growing, and that it kind of carries it along in the tide. So all of those will combine to make the asset look better if you look at it over a period of time instead of just the year one acquisition cap rate, which is what a lot of investors wind up doing. So when you do look at it that way, these deals can start to make a little bit more sense. And then with treasuries falling off a cliff last week, like Bryce mentioned, the 30-year money you can now go out and find, we'll say at 3.5%. So now you have cheaper money. You're doing a 65% loan to value. Your interest rate is 3.5%. You're still doing a 30-year amortization. That means that you can support a loan of $2.7 million, 2.716, and just press the I believe button on that. I can show you how the math is done on that. So at 65% loan to value, that means you can support a max purchase price of 4.18. So now you go to the seller, you present him with the hard realities of multifamily finance, and he realizes the error of his ways, and you agree to this $4.18 million purchase price, and you both live happily ever after. The seller takes the proceeds from the sale, goes and lives in his cabana in the islands, and you get an apartment complex where you get the fixed toilets and chase tenants for the rent. So it's a great trade. I mean, it's the American dream, so there you have it. So that's a bankable deal, and that's how these things will often get done.